Hey, good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. Happy Sunday to all of our listeners and all of our viewers out there. And here we are getting into the fall weather. Boy, Tony Shore, my co-host from over in Minneapolis, Minnesota. Usually in the summertime, I say, Tony, thank you so much for all the nice weather you sent over the past week, because obviously you get the weather we get usually a day or two before. But Tony, you can keep this cold, man. Now we're waking up in the mornings and it's in the high 30s and low 40s. And the cool thing is the colors are changing, the leaves are changing, but it's cold. So you can keep that cold over Minneapolis. Keep sending us the sunshine. How's everything going, Tony?
Well, I'll tell you, yesterday it was very windy, very cold and blustery, even a little bit of moisture, a little rain. So be looking for that cold, blustery weather over there.
Well,
Jason.
It was pretty cold this morning, but if you had it yesterday, I would think probably in the next day or two, then yep, absolutely. We're going to get the wind and the blusteriness. And it looks like our forecast is a little chillier for the next couple of days. And then towards mid to end of the week, it's warm again. But so, hey, welcome again, Tony. Here we are on another beautiful Sunday morning here in Michigan. And as most of our listeners and our viewers know, this show was actually recorded back on Monday. So we always pick up on these shows by Tony and I just catching up on the weekend. How's the family? What's going on? Obviously, we're big sports fans. Here we are in the football season. Tony, your team doing great. The Minnesota Vikings over there. They had a bye week. So good thing is you're still undefeated.
Yeah. Yeah, we're 5-0. Hey, better news, though, right now for the Lions. They looked amazing last weekend. A huge win. You stomped the Cowboys.
Big win for the Lions. I mean, especially, I guess kind of maybe a makeup game for last year when we talk about the last game when Dallas played Detroit. And so it was a great game overall. You know, the Lions look great. I mean, offensively, defensively, they're playing awesome right now. What a heck of a team. What a great season they have going. Unfortunately, for those of our listeners and viewers that saw the game, or I'm sure you've heard since then in the last week, unfortunately, we lost Aiden Hutchinson, our star linebacker, to a brutal leg break as he was sacking Dak Prescott. So great sack, great game, but unfortunately, broken leg. Looks like he'll probably be out for, I would think, the remainder of the season. Hopefully not a career-ending injury because, man, that guy's just an absolute stud. So, great game. We love the win, but I think the loss of Hutchinson hurts a lot worse than the win feels good.
Yeah, that's true. It does. It kind of overshadows the win, even though it was a huge win. I mean, you just those kind of victories where you just had an amazing game. But you're right. That's a devastating injury. Now, I had a great weekend, just watched sports and hung out with the fam. But Jason, and I know you've been busy with the kids. Let's get into our special guests. Let's tell our listeners who we have here today. You've got an A-lister once again on the show.
Yeah, we seem to get lucky. I'm not sure. I think you must have some pull over there with Gradient because, when I like to do at least once or twice a month, I love to do guests on the show. And whether it's you or me, Tony, and I'm going to give the credit to you for sure, being an insider over there at Gradient Investments, we're able to pull one of their top portfolio managers, Mr. Keith Gangl, again. And so, Keith, welcome to the show. Thanks for taking time out of your busy morning and your busy schedule to record with Tony and I today.
Yeah, thanks for having me. I think it's more you, Jason, than
me. Yeah, I think so too.
And speaking of football, that's fantastic. You know, the Vikings and Lions are coming up. So,
well, as our listeners are listening to the radio show this morning, it's only a few hours away because as we record on a Monday, it's this coming Sunday. So a few hours away as you're listening to this recording this morning, we're going to get to watch the Detroit Lions in Minnesota Vikings. Again, we came off one heck of a game yesterday. Hopefully we keep that momentum going. I was teasing Tony last week when we were recording, Keith, that it's a darn good thing that the Vikings had this past week as a bye week because they're going to need all the rest and preparation they can get. So, hey, may the best team win, right? And sometimes it's a lesson I teach Carson all the time. Sometimes the best team doesn't win. But when you got two teams like this, Minneapolis is undefeated. They look great.
It's going to be
now.
a good game.
Yeah. Oh, the Lions are looking great. Unfortunately, we won't have
fantastic.
Hutchinson.
Yeah.
The Lions look fantastic.
Yeah, they look good.
I'm concerned, but I am willing to put my money where my mouth is, Jason. And I don't know if it's money or something else, but you and I, Jason, should have a little wager.
I think we should.
I'll take the Vikings. You take Detroit just to win, no spread.
Okay, just straight up.
Whoever team wins. What do you want to do? Do you want to do $10, $20, or do you want to do? You have to wear some Vikings gear on the next show. What do you want to do, Jason?
Oh, well, I mean, that's, I rather just, if I'm going to lose, Tony, I'd rather just lose money. I'd rather just suck it up and pay you, because, the thing about having to wear Vikings gear is you're probably going to make me buy it. And I just can't buy that. And then I'll own it. And then there'll be pictures and video of that forever and ever. So I'd rather just hand you $10. So why don't we go $10 wager on the game?
Okay.
Nice friendly $10 bet. And then I did mention to Carson last week after we were recording that you said you wanted to maybe put a little wager in with him that he better save his lunch money. And so Carson said he's ready as well.
All right.
So he wants to he said he wanted to do a $5 wager if you were open to that.
Sure.
And so you and Carson are on the line.
$15 Antonio.
I'm gonna have to get out that crowbar and pry my wallet.
I hope it doesn't break you, Tony. I hope it doesn't break you. Oh, and Carson also said he wants cash on pay. He doesn't want a no payment plan or anything. Okay, he said just if he wins the $5, Tony, it's cash only, COD. Okay, no payment plans this time.
All right. We'll see who wins. We'll see. All right. Well, hey,
great football game. We'll be watching again. Unfortunately, we won't have Hutchinson, but look out, Vikings, because Detroit's coming at you.
True. You got a team. I mean, I'm more worried about this game than I've been about any of the other games. I think we had those in hand, but this game, that's going to be a tough one.
Lions are good.
Yeah. Lions are great.
Keith, so for our listeners and our viewers, we do have Keith Gangl, portfolio manager for Gradient Investments, on the show. And so Keith, Tony and I always go back and forth and razz each other a little bit about the Lions and the Vikings. And so what's your thoughts coming up into this big game today?
I'm a huge Vikings fan. I'm a lifelong Minnesotan. So the problem is I've been beaten down. So you and I are about the same age. So my enthusiasm for the Vikings has kind of waned over the last few years. So I'm not going to get too excited. I think it was last time we were 5-0. I think it was 2016. I was reading the stats, and I think then we literally won 3 more games the rest of the year. So I don't know. We beat some good teams, so I think they are legit. But Lions look really, really good. So I think they're the cream of the crop, I think, in the NFC. So it should be a good match.
Yeah, it should be a good matchup. Well, I appreciate hearing the feedback from you. So let's kind of jump right in. I mean, I know, Keith, you've been on my show multiple times, so thank you very much for that. It's awesome. Whenever we can have you on, I know our listeners love it. We usually get half a dozen calls or so or emails after the show, either the day of or during that week. Comments and feedback from our listeners and our viewers telling us what they thought of our guests. And then some of them have questions for the guests. And I know I've relayed some of those to you in the past. So thank you very much for being on the show. And by the way, listeners and viewers, if you do have questions for Keith or any of the other guests I have on the show, by all means, just give us a call. Give a call here to the office. Send us an email. Keith and his team are wide open to answering any questions or going into a little more detail, I guess, on some of the questions or topics we do cover in the show. So give us a call, send us an email. Be happy to get that off to Keith and his team, and they can answer some of the questions or concerns you might have. But let's jump right in, Keith. So I know we want to really kind of start off the show today talking about, we just finished up the third quarter of the year, just jumping into the fourth quarter. Before we jump into the fourth quarter, bring us up to speed a little bit, maybe year to date. We just finished up a quarter pretty darn strong. So let's talk about year to date, finishing up the third quarter. And then in the next segment, we'll get into kind of the Feds and the elections and earning seasons and fourth quarter in the year ahead. So let's talk a lot about this year so far and pretty strong third quarter.
Yeah, this year, like the Vikings and the Lions, it's fantastic. I mean, through the third quarter, the S&P 500, the market, when people talk about the market, they're referring to the S&P 500. It's up 22%. That's a big number through 9 months, right? And then you got to just back it up last year. Remember that last year, the markets were up 25%. So it's 25. in the first, 3 quarters this year, up 22%.
I mean, that's almost a 50% growth in 2 years. That's crazy.
That's a crazy number. And I mean, the year before was down almost 20% as well. So that's why,
true,
working with you is really important, because you always tell people, it's time in the market. Don't try to time the market. After that, if we go back up, 2022, markets are a little volatile. It's like, no, stick to your plan. And look what, like you said, next, almost 2 years, you're up 50% of your money. So again, you don't want to take your money, out and try to time the market. I've been doing this for almost 30 years. I used to have a lot more hair. It's the market.
Well, I've been doing this for 20 years now, and mine's starting to go away on the sides and turning gray. And
yeah, you wait another 10 years, you won't have much left out there. But anyway, it's very difficult. And again, I've been doing this professionally for almost 30 years. It's hard, almost impossible to actually time the market. Again, that's why it's having a nice investment plan, and at the margin, when things have moved very, very well to the upside, then you want to trim, make sure you're in your risk tolerances, and vice versa. When you have those tough years like in 2022, you want to be putting that money you have on the sidelines back into the market. So that's exactly where we're at right now. Again, so the first 3 quarters of the year were really strong at 22%. Even the bond market this year is almost up 5%. So that's rewarding as well. So most of your clients are in retirement, so they're going to have that stock market, which we like to talk about, and that's more where I spend a lot of my time. Again, that 22% is an eye-popping number, but again, even on the bond side is almost a little over 5%. So that's a nice mixture. If your clients are going to have stocks, and you also have that 5% of the bonds, which is great. Again, now if you go back to the bond market in 2022, the reason I keep on referring to this, because that's it was a pretty bad year.
That was a pivotal year. I mean, stocks were down double digit, bonds were down
13%. That was the worst bond market in 50 years. So that's why it's nice this last 2 years. We've recouped a lot of that, and we've actually making some headway on the other side as well. So again, markets are strong. The quarter itself was almost up. If you look at Q3 itself, the stock market was up 6%. Very good number. September, which historically is the worst month of the year. Like if we averaged, going back to the 1919 of every month in the S&P 500, the only month that's actually down historically on the average has been September.
Yeah, September is kind of known for being a black eye, right? I mean, just end the fourth quarter on a black eye with September, and pray for moving into the fourth quarter, but a little bit different this year.
Yeah, no, and market finished up a few percent in September as well. So like I said, the quarter itself was up 6%. So a lot of good things are going on, and then we'll get into what we think is going to happen in the next quarter. But the positioning is very well. We like things are going on. Unemployment's still low at 4.1%. People are working. And my mantra is, when people have jobs, they have money in their pockets, they love to spend. The U.S. consumer will outspend anybody. And then, if Carson gets Tony's $5 next week, then that's going to be levered up probably.
That's going to be leveraged up for sure.
Yeah.
Yeah. Carson's a pretty good little saver, but free money from Tony like that, I don't know if he may frame that. He might actually frame. He may frame it. He may ask to get it autographed. I'm not sure what he's going to do.
Wow. The Lions haven't won yet. Let's not get ahead of ourselves.
Yeah. The framing, that might be the worth it, right? Just get a picture of that when Tony opened up his
$5
wallet
out of Tony. Yeah. You get $5 out of Tony. That's a pretty big deal.
Me holding my wallet upside down, trying to shake out that 5.
The butterflies and moths flying out of it.
That's good great.
Stuff. Yeah, that's great. Thinking about where we are, in the last year and a half, right? Year and 9 months, as you mentioned, Keith. 22 was a brutal year. First time that stocks and bonds were both down over double digits in all 3 of our investing lifetimes, right? Over 50 years. So bad year, but we look at how we rebounded in 23, phenomenal year. We look at how we've rebounded so far in 24, absolutely phenomenal. We look at, like you said, with just finished in the third quarter, the S&P up over 22%, bonds up almost 5%. Life is pretty good. The market is pretty good right now when we talk about performance of the market, right? So I think that's important to keep in perspective, though. As you mentioned, 22 was not a good year. So when we have a year like 23 and 24, it makes up for a lot of those losses. And it puts us on a very positive note. Now we'll come into the next segment. We'll start talking about, but now what? Okay, we've had a pretty darn good run so far in 24. Third quarter was awesome. September, normally the black eye month of the year, historically was a pretty darn good month overall this year as well. But we got to start talking a little more about the Feds, the decisions the Feds are making, interest rates, inflation, all these types of things. We got to start talking about the election. I don't like to talk about the election when it comes to portfolios. You will tell us why. I love talking about the election. Just let's not mix it with our portfolios, and you'll give us a great reason why. And then we'll finish out today's show talking about earnings season, because here we are. Earnings season started last week, so I know you got some real cool things to talk about there as well.
All right, and we're going to be right back with more of Keith Gangl, portfolio manager at Gradient Investments. But first, let's give away some copies of your book. Jason, you talk about the markets and volatility and safe money versus at-risk money in your book, and that's why we're here talking about these things today. So if you don't mind, I'm going to give away 3 copies of your book. What do you think?
Oh, that's a great idea. Yep.
Yep. All right. So for the next, let's say 10 callers, the next 10 people to get a hold of you, and I'll give that number right now. It's 989-835-7203. Again, that number to call to get your copy of Jason's book, and it's a great one, 989-835-7203. And it's called Empower Your Retirement. Again, get a copy of Empower Your Retirement. Jason wrote this book, and there's things on how to maximize Social Security, how to plan for retirement, investments, how to cover healthcare costs, inflation. It's a great book. I encourage everybody to pick up the phone, and you can also schedule a no charge, no obligation consultation with Jason and his team. The number again, 989-835-7203. All right, and we're back with your Financial Empower Hour and our host, Jason Cryderman. Jason, we've got a special guest with us today, don't we?
We do. We have an awesome guest again. We have Keith Gangl, portfolio manager from Gradient Investments. And this isn't the first time Keith's been on our show. I love having Keith on. He's such a wealth of knowledge, such an awesome and just truly a reasonable, relatable man that just is not going to blow any smoke. He's just going to say, hey, here's what's going on in the markets, in the economies. Here's what Gradient Investments is doing in the trenches with investors' monies. And so we love it when we have the opportunity just one-on-one to sit down and pick your brain, Keith. So thanks again for being a guest on the show. As Tony mentioned, the title of our book, because Tony loves to give away copies of our book every show. I love it, Tony. You've been giving away so many copies. You're helping so many listeners and viewers just become educated and empowered to make better decisions with their hard-earned money. And the tagline of our book is plan for the best, but prepare for the worst. Now, if we think about that, what we just talked about, Keith, in the last segment was we plan for the best, like 2023, 2024. These are 2 best years right now in the market. But we also have to prepare for the worst, like 2022. That was a bad year. And when we build portfolios and financial management plans for families, believe it or not, we don't just build portfolios for the best of times, 23 and 24. We also prepare for the worst. We insulate portfolios from potential risk like 2022, like interest rates going up and bonds going down. So it's cool to hear you talk about that, reminding people that, yeah, as good as the market was last year, as good as it is so far this year, we got to be careful not to celebrate too much and get caught with it, get caught exposed. And that's why, our tagline again, plan for the best, prepare for the worst. And that's another reason we've teamed up with Gradient Investments for so long, is because their management philosophy is absolutely just like that. They want to get the best of all the upside opportunity for as many of the clients as they possibly can on every dollar. However, they're realists again. They realize we can't just have everything go up, 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 and we have to be prepared for when things don't go as good. And that helps build not only the portfolio in good times and in not so good, but the relationships, Keith. That helps build them with us, as well as helps build them with my families that I serve. So thank you again for everything you and your team at Gradient does for us and the families we serve. But let's jump right in. Let's talk about the Feds. Pretty tough nowadays not to hear somebody say, gee, are the Feds going to raise interest rates? Are they lowering it? What are the Feds going to do? And I think they're going to lower rates 0.5% or 1%. So there's a lot of talk out there about what the Feds have done and they think the Feds might do moving forward through the rest of 2024. So what is your take right now at Gradient Investments on what the Fed has been doing and what it looks like they may do moving forward?
Yeah, talking about the Fed, we've been doing it for quite a few years now. It's not one of my favorite subjects, but we need to know.
Right.
We really need to
We
know
have
what
to
they're
though,
doing,
right? I
right? We
mean,
have to understand it, right?
yeah.
Back, again, my career, early in my career, middle of my career, we didn't really care what the Fed was kind of on hold. They didn't do a whole lot, and we were concerned about company fundamentals and how we should allocate money. But the last 4 or 5 years certainly been different. Ever since COVID, we had the inflation spike, right? So what
Mhm.
it was the Fed step in and does, it actually starts raising interest rates to slow the overall economy, to start bringing that inflation rate down. And now they've done that. We peaked in, I think it was June or July of 2022, or 21, our inflation at 9.1%.
Yeah. It's
And now
crazy.
it's great, right? And the Fed's target is 2%. So we're getting down there. We're at about 2.6% as of the last reading. So we're well on the way down there. And so the biggest question was, after the tightening cycle, when does the Fed actually start easing, right? So the first
Mhm.
tightening cycle began in 2020 after COVID. And we've been in the pause mode for the last 14 months. The Fed hasn't done anything. They're actually evaluating the data that comes in. That's what they need to do. And now we're starting to see things finally starting to slow a little bit. So what do? They actually came in and actually cut 50 basis points last
Mhm.
month. So I think that kind of spurred, or why September was such a strong month. I think when the Fed's cutting, that's generally good for the economy. That means the
Sure.
Fed's gone from
Mhm.
the tightening cycle to the easing cycle. And I think that's where we're at. That's good for the economy, which is ultimately good for the stock market. I think that helped propel a little bit of that performance we've seen in September.
Yeah, no, I think you're right. When we talk about the Fed's, cutting rates or the Fed's fund rates, interest rates, I talk to my clients all the time, but interest rates are kind of like that double-edged sword, right? So when we borrow money, we want cheap interest rates. We want very low interest rates so we can borrow money cheap. However, when we invest money, we want high interest rates. We want to be able to invest money and
Right.
interest rates are interest rates. They're the same. I mean, you can't say what we have, have your cake and eat it too. We can't have
Mhm.
low interest rates when we borrow money, but high interest rates, it's going to be what it is. So when Feds do start cutting rates, like they just went down 50 bips last time, we're talking maybe a 1/4%, 0.5% this coming Fed cut. I'm not sure what that looks like. Maybe you know a little more about that, but it does help determine consumer loan rates. And when we talk about spending money and building houses or buying cars or going into business or doing something, when people have to borrow money 2-3 years ago, it was a lot easier to borrow money at 4 or 5%. People are finding it harder to borrow money now at 8 or 9%. And so I think when we hear the Feds are going to lower rates, that's a good thing for the economy when we talk about being able to borrow money cheaper. But on the flip side of that coin, again, CDs as they're maturing now or other fixed rate investments, we might see those rates coming down a little bit. And you might not be able to make as much on your fixed income investments because they're directly tied to interest rates as well.
Yeah, very well said. That's the double-edged sword, right? So as a retiree, someone's built their nest egg, you like these high rates that we've seen recently,
Mm-hmm.
right? Because then it's whether it's CDs or safer money, you're getting a nice return. And now 'cause
Absolutely. Yeah.
that's driven really by the Fed's fund rate, so which was at 5.25. Now we're down to about 4.75 with that 50 basis point cut. So now, as CDs roll over, like you said, that safer money, you don't earn quite as much. But on the other end, it's good for the consumer, the person that's borrowing. A lot of the credit
Mm-hmm.
card, rates are based on where the Fed funds rate is. Car loans, the shorter time periods, that's based on directly
Mm-hmm.
on that. So as the Fed cuts, those rates should be cheaper for the consumer, which again, the consumer drives about almost 70% of GDP, which is, gross domestic product. That's one way we measure the health of the overall economy. And again, like I said, people are working, they have money in their pockets, they will spend, which drives the overall GDP, which ultimately ends up driving the stock market as well. So we're in a good spot where, generally speaking, when the Fed starts cutting, that's a tailwind for the market. So when you hear that, it's generally true. And then your question was, we have 2 more Fed meetings for year end. Now, what will the Fed do? Well, I think the economy is very healthy right now. So I caution them on cutting too aggressively. If they
Mm-hmm.
start cutting too aggressively, I think that overheats the economy and it can flare that inflation back up, which everybody's had a problem with inflation the last several years. So now they're getting it under control. I just want to make sure that they're more measured. So I would expect maybe a 25 basis point cut in the next meeting, which is right after the election as well, which is a weird timing anyway.
Weird timing, isn't it? Though, yeah,
Yeah,
just
weird.
crazy timing.
It's just what it is. That is the natural timing of it. So I would assume they're going to do about a 25 basis point cut right there, and then probably another 25 in December. So that would be another 50 basis points, which is fine. I don't like to see these big, cuts of 50 basis points, or some people were talking 75 basis points a few months ago. Because I think, again, if people are working, that unemployment rate went to 4.3%, and people are getting a little nervous. I think that's what contributed to the Fed cutting 50 basis points.
Mm-hmm.
But that's actually reverse course last couple of data points we've seen. That's at 4.1%. So again, that's a healthy number, and it's a balancing act, right? It's like you don't want
trying to ease us down.
Ease us down, right? But I don't think we're going back to where the time periods for the last 25 years. We've seen 11 years of that 25 where the Fed funds rate was at zero.
Right.
When it's at zero, people get crazy. It's like you were talking about, it's not free money, but it's pretty close to
pretty darn
money,
close.
Right. And you can leverage yourself up, and then you can get some problems in the system. We want to avoid that. So we want to go to kind of a natural balancing act. I think that's probably around that 3%, maybe 3.5%. So if we're at 4.75, you can expect the next year and a half plus maybe the Fed cuts another 150 basis points. So which, again, if you're borrowing
spread
money,
out over time.
Yep, spread out over time. And if you're borrowing money, that means, generally speaking, loans should get cheaper over the next year and a half. If you're a saver, that means you're a little more difficult to earn that little extra premium over the next year and a half as well. But again, it's a balancing act. But I do not expect the Fed to go down to that zero rate and really pump up the economy, because the economy is doing fine. I mean, in Michigan, things seem like they're pretty good. People are working, and same in Minnesota, people are working. If you want a job, you can basically find a job. There may be some skill, mismatches on some of the jobs you're looking for, but generally speaking, if you're willing to work, there's a job for you.
Yeah. Yeah. Well, we need to take another break, guys, just really quick to give away a few more copies of the book and to let our listeners know how they can get a hold of you, Jason, and your team there. I think it's great. People might have questions. Maybe they don't have a plan in place. Maybe they aren't sure where their investments are at, or they don't have a plan for retirement income in place. So listeners, viewers out there, pick up the phone, give Jason and his team a call. We're giving away more copies of the financial power. Empower Your. I get it confused with the name of the show.
Hey, that's all right. You'll get it.
Empower Your Retirement. Plan for the best. Hope for the best, but plan for the worst. Right, Jason?
No. Plan for the best, but prepare for the worst.
Be prepared. Don't hope.
That's right. Don't hope for it. I mean, you want to hope for the best, plan for the best, but be prepared, Tony. Be prepared
today. Jet lag. All right. But the number to call to get a copy of the book, Empower Your Retirement, is 989-835-7203. Again, that's 989-835-7203. And the next 10 callers are going to get a copy of the book, Empower Your Retirement. Plan for the best, but prepare for the worst. Thanks, Jason and Keith. We're going to be right back with more after this. Welcome back to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host, the man with the plan, Jason Cryderman, and our special guest, Keith Gangl, portfolio manager at Gradient Investments. And it's been a great show so far, hasn't it, Jason?
Yeah, it's always an awesome show when we can have a guest on like Keith and anyone else from his team there at Gradient Investments. I know our viewers and our listeners love to hear from you guys, Keith. They quite often send us a lot of emails or give us a lot of phone calls the day or the week of the show when you guys are guests. So that tells me we're doing the right thing. You're reaching out there and touching people and getting their attention. So thank you again for this opportunity. And we kind of started the first segment today talking about how strong the markets have been through 2023, especially in 2024. This year, we had a really strong quarter. Here we are in quarter four. The last segment, we talked a lot about the Feds and how they raised rates and then how they were cutting rates and how that impacts borrowing money and saving and investing money. And so now I want to just kind of wrap up the show in the last two segments here, Tony and Keith, by talking about that E word, that election. We'll talk a little bit about that. Again, the gist of it, and all of my clients have heard me say this 1,000 times. They're sick of hearing me say it, but politics and portfolios don't mix. Okay. So you'll hear Keith talk about that. Yes, we need to pay attention to the elections. Yes, we have to be involved. We just can't become too emotional and let our money be involved with politicians or political cycles or politics at all. And then we'll end up the show today on our last segment talking about the earnings season, because we are at earnings season. There's some big news coming out there as well. So for the next couple minutes in this segment, Keith, let's talk about, first of all, guys, if you're anything like me, you're just ready for this election to be over. Like I'm so done with it. I mean, you can't turn on the TV, the radio, Facebook. You can't go to the grocery store. You can't drive. This is one of the, I don't know, this is a totally different election than I ever remember in my 50 years seeing experience. And I just can't wait till it's over. So let's talk a little bit about the election, but more importantly, Keith, what is your gist when it comes to the election, politics, and portfolios?
Oh, you want me to predict who's going to win? Just kidding. No, we don't go there.
Wait, Tony, we need a drum roll.
Yeah, no.
Exactly. No, the biggest takeaway, and you've told your clients many times, is keep your political views separate from your investment decisions.
Absolutely.
Just because your guy or gal wins or loses, do not pull your money out and say, oh, my person didn't win, I'm going all cash. Vice versa. You just don't want to do that. If your person wins, saying, oh, the market's really going to take off because things are going to be all rosy, all the policies that he or she are proposing are going to happen, which, again, that's part of the problem is a lot of these proposals that both sides have just never happen. They just don't. I mean,
think about that historically. There's a lot of stuff we hear is just that we hear it, but then 2 years, 4 years later, we're like, well, gee, remember when he or she said this? Whatever happened? Like, okay, I liked that, and so I voted for that, but that never happened. And so we, hindsight is 2020. We kick ourselves in the butt, right? So, but again, I would voice just like you said, Keith. We cannot let our portfolios and listeners, Keith and I and everybody else you've ever heard on this show, and probably a lot of other people in your lives, aren't just saying this because we make money off invested dollars. We're saying this because from a fiduciary standpoint, it is truly in your best interest. Keith and I and the team at Gradient, we have literally research after research. We could show historical charts and numbers and graphs and years and presidents and Republican and Democrat, you name it. We have the proof and the evidence showing your time in the market through the Republican, through the Democrat, you're going to be way better off financially than if you try to predict or you try to get emotional and pull your money out. It just doesn't work. And so we're doing this truly from a fiduciary standpoint, listeners and viewers, that this is 100% in your best interest. People usually make the most financial mistakes when they allow their emotions to take control. They try to predict what's going to happen. And we saw this happen in the last election, didn't we, Keith, where people thought, oh, gee, if he gets in, the market's going to go tank. I'll take all my money out and put it on the sidelines. Well, they missed out on a heck of a lot of growth and opportunity. So from fiduciary standpoint, from myself and from Keith, be careful. Be careful of the decisions you're going to make with your money before the election. Chances are it's not worth it.
Yeah, we invest in companies, not politicians, right?
Absolutely.
So that's I'm the guy that's actually buying and selling these stocks. We're looking at the fundamentals of these companies, and some of these companies could change a little bit depending on policies. Again, who knows if these policies even get enacted? So that's why you're double guessing if, does this policy happen? When will it happen? I mean, generally speaking, as an investor, we like gridlock. I mean, so it's
absolutely
Republican, Democrats mixed. You can pick your pitcher, whatever you like. That's why it's easier to invest when you see that situation, because there's no big policy changes. Everybody's kind of status quo. Yep. So as the CEO of a company, he's like, okay, now this CapEx project I have, I know nothing's going to change here. I'm going to invest. And again, we're investing in companies, not politicians. And that's the way to do it. And I can throw some stats at you. If you go back to elections since 1950s, if you just invested when the Republicans won $10,000 in just in Republican presidencies, would only be like $60,000. Again, if you went all out. And the Democrats did a little bit better. They were actually almost at 200,000 just when Democrats were. But if you kept your money in the whole time, regardless of who was in there, that $10,000 accumulated to almost $2 million in today's dollars. Just think about that. So you had 60, 200, $2 million.
So the market doesn't care what party holds the president. Is the president.
Not. And there's so much underneath that covers, right? Is it a split Congress? Not a split Congress. It's different things like that. Generally speaking, those have historically done the best, whether it's Republican top, some kind of mix underneath, or vice versa, Democrat on top. And so that's a situation we'd like to see. But again, it's going to be a very close election. So that's one thing, markets could get a little bit nervous if on election night we don't find out the results right away. That just So you're,
that's uneasy for everybody.
That's
right?
uneasy for everybody.
The elections can cause market volatility, though, right, guys?
And so then that's why, working with Jason, you have a diversified plan, right? So it's like you're not betting all one way or the other as well. So there could be some, the markets are up 22, even a little bit more now as, we're going into the fourth quarter, which historically has been the best quarter. So if we use history as a proxy, Q4 is better than the previous 3 quarters. So we'll see. So, the markets are up a lot. So, I mean, that could be a little bit of just kind of a knee-jerk reaction of, I'm going to sell off. But I think that would be very, very short-lived. Again, people will start looking at the fundamentals and decide, okay, this is not as bad as I thought it would be. And we want to invest in these companies.
So what I hear you saying is keep your political views separate from your financial ones, your financial decisions. And I know, Jason, you say that you've been saying that all year as we've headed into this election. So I appreciate the info there. We're going to take another really quick break just to let our listeners know we have a few more copies of that book to give away, Empower Your Retirement by Jason Cryderman. And call 989-835-7203. That's 989-835-7203 to get a copy of Empower Your Retirement. And we're going to be right back with more of your Financial Empower Hour. All right, I'm your co-host, Tony Shore, for your Financial Empower Hour. Our host, the man with the plan, is Jason Cryderman. Jason, great show so far today. And our special guest who's here, amazing, Keith Gangl from Gradient Investments. He's a portfolio manager there, talking about the third quarter, how good that was, the Fed, the election coming up. So, Jason, where should we head next?
Well, I love having Keith on the show, and Keith's not just a fly-by-night guy that looks at the USA Today every morning to help pick a stock. Keith has actually been in this role in the financial field and as a portfolio manager in other realms for over 30 years. He is a CFA, so he's one of those guys. I mean, he's kind of a big deal. He knows what he's talking about.
You must have started when you were 10. If it's the last 30 years,
look at my hairline. So I think I'm
a good day over 40.
So he's been there, done that. So to be able to pick the brain of somebody at this level is awesome. And it's been a great show. So I thank you. And I thank you for my listeners and my viewers. Let's wrap up the show today talking about the season that we're in. And I don't mean Halloween season. I don't mean, the Thanksgiving season. I mean the earnings season. So this time of year right now, last week we saw some big numbers come out. This week we're seeing some more reporting. So let's help share with my listeners and my viewers, Keith, what does it mean? What does earnings season mean?
Sure.
What is it? And what are we seeing right now? And what can we expect moving forward?
Yeah, earnings season is when we get kind of a report card of these companies. They report 4 times a year, and earnings season is typically 3 to 4 weeks long. So it officially started last week and usually kicks off with the big banks, which was JP Morgan and Wells Fargo. They had a great quarter, so both of them are positive. And generally speaking, JP Morgan with Jamie Dimon, who's the CEO, has been a little bit more cautious on the consumer. He actually was a little bit more positive this time around. So again, that's kind of been what's the consumer doing? Are they pulling back? Are they not? Are they working? Are they not? He actually was a little bit more positive, which he's been pretty much saying the storm clouds are on the horizon. Things are getting bad. So it's a nice change of tune. So I think that sets a positive tone for the overall market. And again, this will be how we judge our companies that we invest in. All the companies I own in my Core Select and Jeremy and all the other portfolio managers that they own, we'll be evaluating these companies when they report their earnings, saying, are they doing what they said they're going to do? And are they beating and exceeding expectations? That's what we want to see, beating and exceeding expectations. Generally speaking, just if I had to pick one thing that drives the overall stock market over long periods of time, it's earnings growth. Earnings growth of these companies in S&P 500, if it remains strong, that'll be a good tailwind for the markets to continue grind higher. Again, now we just talked about we've had a good year and 9 months, so I would temper everybody's enthusiasm to don't think the next year and 9 months will be like we've seen the last year, year and 9 months as well. I think we need to moderate that a little bit. But earnings, when we look at earnings growth expectations for next year, they're expected to grow 15%. Just so you know, normally if we get earnings between 6 and 8, that's very healthy. That's double it. And I think the stock market looks forward to pricing things. And I think that's what it's looking at next year, saying, oh, if we're going to do 15%, that's why the market's been so strong. Now, I think 15% is a little too high. I think it's more like maybe 10, but even 10 is going to be good enough, I think, to keep moving the market forward. So there's this time period, I'll be very busy the next 3 weeks, analyzing all these earnings and making sure they're coming in. Again, unfortunately, that we'll have some clunkers in the group, and hopefully there's very few of those and a lot more bright sides on the thing. And I do think earnings as a whole for this quarter, expectations for the S&P 500 up 14% year over year. So again, very strong quarters are expected out of these companies. So we'll see. The proof will be in the pudding. We got United Healthcare is a big company we own reporting this week. We a lot of names like that. Netflix is a big name that a lot of your probably clientele and consumers actually use. I have, my family certainly loves.
Who doesn't right nowadays? Who doesn't have a Netflix account?
Yeah, I don't know anyone who does not.
It's a very, everybody uses it, everybody pays, and every year they keep on increasing prices a little bit. As a consumer, I don't like it. As a holder of the stock, I love it.
Sure.
So
that's a double-edged sword again, just like interest rates.
It is. Yeah.
So exactly. So those are the things we're analyzing. And again, this is a busy season. And again, we're off to a good start, but it's early. So hopefully we don't see any curveballs and again, that's why we analyze these companies. And when we talked about, elections versus companies, this is what I mean by analyzing these companies. I'm going to look at their company earnings. Are they delivering what they said? Are they going to continue to grow? Are they going to offer new products? How are they going to grow? And again, that's what we want to see. And that's what we're looking for.
I think that's great. Well, you know what? We're almost out of time. Jason, great show today, by the way. Great to have.
It's been a good one. Again, Tony, thanks for everything you do for us and my listeners and viewers. And Keith, it's awesome to have you and your team. So please go back to the team and thank them again for everything you guys do for us and for our clients. It has been a great year. Things are going really well right now in the economy, I think, and a lot of the analysts and things you look at in here. So, but we have to be, stay optimistic, but also be aware, be cautious. And that's that whole tagline again from my book is plan for the best, but prepare for the worst. And so having you on our team is Gradient Investments, who manages our money for our families. And then in conjunction with the plans that we build, we've been able to do really, really well, not only this year, but even through the not so good years like 2022, like 2008, like when COVID hit. Our families actually fared pretty darn well through all those unfortunate downturns because of how we build portfolios, planning for the best, but being prepared and insulated for the worst, and having Keith and his team at Gradient Investments behind us to manage the money the way you do. So thanks again for everything you guys do at Gradient Investments.
Thanks for having us.
All right. And listeners, before we go, make sure you have a plan in place or get a second opinion on where you're at with your finances. Give Jason and his team a call. It's 989-835-7203. That's 989-835-7203. And that does it for today's episode of Your Financial Empower Hour.